What if every big decision you made had massive upside, but very little downside? That's the simple idea behind one of the most powerful investing philosophies ever shared. Investor Mohnish Pabrai calls it, "Heads I win, tails I don't lose much." At first glance, it sounds like a clever quote about the stock market, but it's actually much bigger than that. Let's explore what this rule really means and why it might be one of the most practical decision-making frameworks you'll ever learn. Who is Mohnish Pabrai? Mohnish Pabrai is one of the world's best-known value investors and a long-time admirer of Warren Buffett and Charlie Munger. He founded Pabrai Investment Funds and built his reputation by following a simple philosophy: buy great businesses only when they're selling for far less than they're worth. Unlike many hedge fund managers chasing hundreds of opportunities every year, Pabrai believes in waiting patiently for situations where the odds are heavily stacked in his favor. Understanding the rule, imagine someone offers you a coin toss. If you win, you receive $1,000. If you lose, you only lose $50. Would you play? Most people would say yes. Why? Because even though you might lose occasionally, your downside is limited while your upside is enormous. That's asymmetrical risk. The potential reward is much larger than the potential loss. Most people think backwards. Unfortunately, many people do the exact opposite. They become excited by the possible reward while barely considering the downside. Someone quits a stable job to launch a business without any savings. Someone borrows heavily to invest in speculative assets. Someone buys a house they can't comfortably afford because property prices always go up. Someone spends years chasing a career they secretly hate simply because it pays well. In each case, the downside is enormous. That's exactly what Pabrai tries to avoid. Starting a business the smart way, people often assume entrepreneurs take enormous risks. The best entrepreneurs usually don't. Consider two aspiring business owners. The first quits their job, borrows hundreds of thousands of dollars, rents expensive office space, hires employees, and hopes customers appear. The second starts online during evenings and weekends. They validate demand before investing heavily. If nobody buys the product, they've only lost some time. If customers love it, they can gradually expand. Same dream. Very different risk profiles. One is gambling, the other is following Pabrai's philosophy. Building multiple income streams. Imagine someone depends entirely on one salary. If they lose their job, their income immediately falls to zero. Now imagine someone who has a full-time job, a small online business, dividend investments, freelance work, rental income. Losing one income source becomes inconvenient, not catastrophic. This is another example of reducing downside while maintaining substantial upside. Instead of relying on one fragile system, you create multiple opportunities for success. Why casinos always win? Casinos don't know the outcome of individual games. People sometimes win enormous jackpots. Yet casinos consistently make money. Why? Because every game offers favorable odds over thousands of outcomes. Pabrai believes investors should think similarly. You don't need every decision to succeed. You simply need decisions where the expected outcome is favorable over time. Some investments will fail. Some businesses won't work. Some career choices won't go as planned. That's perfectly normal. The important question isn't whether you lose occasionally, it's whether your winners become much larger than your losers. Fear often prevents great decisions. One reason many people ignore this principle is fear. We naturally focus on what could go wrong. But Pabrai encourages a different question. Can I survive if this fails? If the answer is yes, perhaps the opportunity deserves serious consideration. Starting a side business while keeping your job, limited downside. Learning a valuable new skill, limited downside. Applying for a better position, limited downside. Speaking at a conference, limited downside. Yet each could significantly improve your future. The power of small experiments. One of the smartest ways to apply this philosophy is through experimentation. Instead of making one enormous bet, make many small ones. Write articles online. Launch a YouTube channel. Start freelancing. Learn coding. Create a digital product. Invest a modest amount consistently. Most experiments won't become life-changing successes, but occasionally one will exceed every expectation. Because your downside remained small, you can afford to keep experimenting. Eventually, one breakthrough can outweigh dozens of small failures. Warren Buffett uses similar thinking. Pabrai often credits Warren Buffett for influencing his philosophy. Buffett rarely buys companies simply because they're popular. He waits patiently for opportunities where the downside appears limited while the long-term upside remains attractive. Sometimes he waits years before making a major investment. Patience itself becomes part of risk management. Rather than forcing decisions, both investors prefer waiting until the odds clearly favor them. Common mistakes people make many people misunderstand risk. They think avoiding all risk makes life safer. Ironically, avoiding every risk often creates bigger problems. Never learning new skills, never changing careers, never investing, never starting a business, never meeting new people, never taking opportunities. These choices may feel comfortable today, but over the decades, they have carried enormous hidden costs. Meanwhile, others take reckless risks without understanding the downside. Borrowing excessive amounts of money, speculating on trendy assets, making emotional decisions, ignoring worst-case scenarios. Neither extreme works well. Pabrai's philosophy sits comfortably in the middle. Take meaningful risks, but make sure failure won't destroy you. Final thoughts. Mohnish Pabrai's famous rule isn't really about stocks. It's about designing a life where your mistakes are survivable, but your successes can be extraordinary. You won't eliminate failure. Nobody can. That single question might become the most valuable investment you'll ever make. If you enjoyed this breakdown, like the video, subscribe to the channel and drop a comment below telling us which investing principle you'd like us to explain next. Thanks for watching, and we'll catch you in the next one.